And away we go. All right. I'd like to thank everybody for coming back here for our third little tutorial on calculating pip value. Essentially what we do here at NurreFX is before we even get to the point where we're buying or selling a currency pair to place a trade, I'm a huge risk manager, and we like you to know all the ins and outs of how these currencies operate before you even press the buy and sell button. What that means is you should know exactly what you're risking, what you're profiting, what each point means in the market as they move up and down, before you even get to the point of how we click buy, how we click sell, when we put in our stops, and when we put in limits. And so that comes down to calculating pip value. Now that we know lot size, we know what a pip is, we know how to define the exchange rate, because we are dealing with currency exchange rates, depending on what pair you trade, the value of each point or each fractional point of movement is going to be different. So depending on lot size, combining lot size and pips from the previous tutorial defines the amount of profit and loss that we can expect on a trade. And it all comes down to three different things, three different types of transactions that we do in the Forex markets. The three transactions, and they're actually very simple, and we're going to do an exercise in the next tutorial as far as going through if you live in a different country, if you live overseas, let's say you live in Australia or Great Britain or in Europe, of how this works. But for right now, we're going to assume that our accounts are based in US dollars, are denominated in US dollars, and we'll go from there. So for me here in the US, I have three different transactions, three different types of pairs that I trade. I have what's called a direct rate transaction. That's whenever I trade a pair where the US dollar is the quote currency. That would be your Euro US dollar, my Pound US dollar, New Zealand US dollar, Aussie US dollar, anything where the dollar is off to the right, is on the right side of the pair and is the quote currency, is considered a direct rate transaction. And those are pretty simple. Indirect rate transactions, those are going to be pairs where the US dollar is the base currency. That would be our dollar Canadian, that would be our dollar yen, our dollar Swiss. Those would be considered indirect rate transactions, and that's where it starts falling into the realm of currency pairs where the pip value can vary slightly depending on the exchange rate. And then we have what are called cross rate transactions, and those are pairs where the US dollar is neither the base nor the quote currency. So for me, that would be like the Euro-Pound pair on that cross rate transaction. And depending on what pair you're trading on a cross rate, or what we like to call a dollar neutral transaction, those pip values can actually vary by quite a bit depending on the pair that you trade. So let's start off with a direct rate transaction. It's very simple. If you live in the US or your account is denominated in US dollars, it's actually very simple because these do not change. The pip value is calculated by taking lot size times tick size. Now you're probably wondering, what is tick size? Tick size is essentially what represents a single pip of movement on the pair that you're trading. For example, if you're trading the Euro US dollar pair, the fourth decimal place represents one tick, 1 point movement, a full tick or a full point of movement in the market. So for an example on this, if I were to buy one standard lot of the euro dollar, what is the pip value? And this doesn't change, and if you trade in a US dollar account, you never really have to worry about it changing. So a standard lot we know represents 100,000 units of currency, and we multiply that by 0.0001 because that fourth decimal place, that represents 1 point. If we had to write out what 1 point is in the Forex market, it would be that fourth decimal place. So that's considered one tick of movement, and that comes to $10. So when we trade a standard lot on euro dollar, we're making or losing $10 per pip. So we have $10 profit and loss for every pip movement. And then of course, for those, most brokers do have it, but for brokers that have a fractional pip, it's just 1/10 of that. Now, if you're trading in a mini account, if you're trading mini lots, if you will, that represent 10,000 units of currency, then your pip value is going to be $1 or just 1/10 of that. And then for micro lots, you're only making or losing 10 cents per pip. So this is what's great about Forex, once again, from our previous tutorial, is that, depending on how much money you have to put in your account and how much risk you actually want to take on in your account, you do not have to. You can kind of customize the size lots you're trading, and you can see that there's a big difference between making or losing $10 for every pip movement, or losing, let's say, 10 cents if you have less risk tolerance in the market. So for me here in the US, in my US dollar-based account, this does not change. So whenever I trade euro dollar or pound dollar or New Zealand US dollar or Aussie US dollar, those pip values don't change. I know I'm making or losing 10 cents per pip, or $1 per pip, or $10 per pip. Now, where it starts to get a little bit different in the Forex market is when we get into indirect rate calculations. And this is, depending on how volatile the Forex market is, this is where some people can start running into trouble because they make too many assumptions of what they're gaining or losing in their account. For an indirect rate calculation, the pip value is taken by is calculated by taking lot size times tick size. So the same thing as the direct rate, but then you have to divide it by the current rate, or what we would call the opening rate of your transaction. So that would be the current exchange rate. So in this case, on an indirect rate calculation, remember that's pairs where the dollar for me is the base currency. So an example of this would be if I buy one standard lot of dollar Canadian at 1.33320, what would be the pip value? Well, I often run into problems myself on this, because sometimes we assume that, if I'm trading a mini lot or a micro lot, that I'm making or losing 10 cents per pip. But I'm actually have less risk tolerance when I trade the dollar CAD, and I'll show you why. Or I'm sorry, risk exposure is the way I should say that. Because on dollar CAD, if I am trading a standard lot, it's 100,000 times 0.0001, which represents one tick or one pip in the market, and that comes to 10. But if I'm buying at 1.33320, I divide that 10, I take 10 and divide it by 1.33320, which is the asking price, or the price in which I'm going to open up that trade, and it comes to 7.500, or $7.50 on a standard lot. So instead of making or losing $10 per pip, I'm actually making or losing much less. My risk exposure is a little bit less on trading dollar CAD because of the exchange rate. For a mini lot, that would be 75 cents profit and loss. And for a micro lot, depending on what broker you go through, some of them might round it down. Some of them might actually have 0.075, or they could use the simple rounding rules of rounding it up to 8 cents. Some might round it down to 7 cents. Some brokers act a bit different when it comes to the rounding on the micro lots. But on a micro lot, that would be approximately 8 cents P&L for every pip movement in the market. And we'll go through some exercises in the next tutorial, not only for US dollar-based accounts, but also if you happen to live overseas, because this is going to work a little bit different for you. And then finally, we have what are called cross rate calculations. Cross rate, the pip value, this is where it gets and when you start trading and get used to the market, you don't have to do this calculation every single time. You can kind of look at a currency pair and where it's trading and pretty much know what the approximate pip value is, but it's always a good calculation to be able to do. For cross rates, that's where we take lot size times tick size, and then we multiply that by the base currency. Whatever the base currency is in the cross rate that we're trading, the base currency is quote to the US dollar. And then we would divide that by the current rate on the actual cross rate itself. So essentially, we have to convert in order to figure out what our pip value is going to be. We convert the base currency over to US dollars, and then we're able to divide that out to figure out what our total pip value is. So in this case, let's say we were going to buy one standard lot of the euro pound at 0.77560. What is the pip value? Now, the other thing that I need to know here is the approximate exchange rate on the euro US dollar pair. Because what we have to do is the same thing. We're trading a standard lot, which is 100,000. We take that times 0.0001, or 1 tick or 1 pip of movement, and that comes out to 10. Then we have to take that 10, and because we're trading the euro pound pair, what's the base currency? Euro. So we need to convert that euro into dollars. So we take that 10 times 1.10295, which is the euro USD quote, and I just rounded it here to 1103. It would be 11.0295. I put in 11.03. It's not going to make a huge difference in the calculations. So now that I know that I've converted that base currency over into US dollars, all I need to do is divide that by my opening price. So 11.03 divided by 0.77560, which is our opening price, comes out to 14.22. There's a lot of people that trade the euro pound pair, and people that don't know how pip value works. Euro pound can often be a highly active trade pair to trade. There's a lot of people that will assume that they are making or losing $10 per pip when they're trading the spot Forex market. And it's very important to know these pip values in the Forex market, because brokers have had issues in the past where people have, let's say, traded the euro pound pair, and let's say they lose like 100 pips. They lose 100 pips on their trade, and they think in their head, let's say they're trading a standard lot, they think in their head that if they lost 100 pips, they look at their account value though, and they think in their head that they've lost like $1,000. They're thinking along the lines of like $10 per pip. And then they look in their account and they see that they've lost $1,422 or $1,422. Do you think there's a big difference between the two? If you look in your account and you think you only lost $1,000, but you lost $1,422, you lost 42% more on the trade than you thought you did. That comes from lack of knowledge, and brokers actually do get a lot of calls on this when people trade pairs like the euro pound, which always has, and not always, but has been known to have a higher pip value. By the way, people never call into brokerage companies when they make more than they planned on making on the trade. They only call into brokerage, the customer service line, when they lose more than they thought they lost. And people have to often explain how these pip values are calculated. So once again, if you're trading smaller lots, mini lots, that would be $1.42, and then a micro lot, they would probably just round down to 14 cents when you're trading the euro pound pair. So again, on these calculations, and we'll run through them once again in our next tutorial and do some exercises here. But the purpose of all of this is for you to be able to figure out, before you get into a trade, you should always know exactly what your risk is. You should know how much money you're risking, and on the flip side of that, how much money you're willing to profit on a trade. And speaking of that, let's go through the total profit and loss calculation, because this one's pretty easy. Once you know your pip value, you would take your total pip gain or loss and multiply it by the pip value on the pair that you're trading, and that's how the brokerage platform or the trading platform that you're using calculates your total gain or loss. So an example of this, and we just used a euro dollar here, is if we buy one standard lot of euro dollar, let's say at 1.09802, and we close our trade at 1.10701, what would be our total profit? Well, first we figure out how many pips we made. In this case, 0.00899, or 89.9 pips. We multiply that by $10, which is the pip value on Euro USD, and that total trade would come to $899 of total profit. Now don't worry, you don't have to hand calculate all your P&L in your account. That's actually done by the trading platform. However, you should know where these numbers come from when you're looking at your account. And there's other things that can factor in your total P&L, which we'll talk about a little bit later. Rollover interest, if you hold a trade for more than one day, or through what we call the rollover time in the market, which is usually 5 p.m. So there's other things that can affect your P&L, either add to your P&L or subtract to it. costs, commissions, being charged on top of the spread if you're with a commission-based broker. So a lot of these things can affect P&L, but this is kind of just the base profit and loss calculation. So in our next tutorial, we're going to go through how to calculate PIP value, and we're going to do an exercise looking at live market conditions. And we're also going to do an exercise for those of you who live in, who may live overseas in different countries, and kind of work through this together. So I will see you in the next tutorial, and we'll be kind of leaving the PowerPoint and going into a live worksheet to do the next tutorial. So I will see you on your next click. So thank you for watching, and I'll see you later.